Welcome to Mr. P's accounting class. In our last lesson, we looked at the expanded ledger and how to more accurately record transactions that involve equity accounts. Specifically, we looked at the capital account, the drawings account, revenue accounts, and expense accounts that are now found under the owner's equity section. Okay, today's lesson is going to be broken down to two parts. We're going to be covering the income statement. We're going to be looking at revenue and expenses, and we're going to actually define them. Okay, some of the information from these new accounts that we looked at yesterday will be used to prepare an income statement. So what do you think an income statement is? Remember, we looked at how to calculate income, we looked at how to calculate profit or loss, but another word for profit could be income. An income statement shows in detail whether the business is profitable or not. It shows if the company made a profit or a loss. And we looked at the formula for that yesterday, which is in its simplest form, total revenue minus total expenses equals profit or loss if it's negative. What accounts do you think would be used to prepare an income statement? Well, if you guessed revenue and expenses, you are correct. So all the revenue accounts, if the business makes revenue in different ways, add those together, and then you subtract from that all the expenses added together, and you would calculate your profit or loss. Here we have a sample income statement. This is the second financial statement that we are looking at. The first one was the balance sheet. It is structured similarly to the balance sheet. Well, at least the title is. First of all, what does the income statement show? Well, it shows, if we look at the bottom here, net income or net loss. Another word for net income is profit. In this case, we have a net income. If this was a negative number, we would not say net income, we would say net loss. So we use those terms interchangeably. So profit and loss, on an income statement, you would actually phrase that as net income or net loss. Let's go over some of the formatting for the income statement. We always start off with the 3 lines as the title, name of the company or the person who owns it, what kind of statement it is. This is an income statement for the second line, and the third line is the date. Now, the difference between a balance sheet and an income statement has to do with the date. If you remember, balance sheet is a snapshot of the business at a specific point in time. So you would have a specific date. For example, what is the financial position of the company on January the 31st? That's why we would write as the date January 31st, 2007. The income statement, because we're looking at the profit over a period of time, is phrased differently. This one, for the month ended January 31st, 2007, tells us, first of all, when it says for the month ended, that this statement covers a period of a month. Which month? Well, if it's ending January the 31st, it's covering the month of January. If this date were to say for the year ended January 31st, then you know that this statement covers a period of a year, which ends January 31st. That would mean that the year had started February the 1st of the previous year. Okay, so this date is something that we will pay attention to when we create our income statements. Dollar signs are used in the same way. First number in a column gets a dollar sign. So in an income statement, we'll typically have 2 columns for numbers. The far right column is used for the revenues. For total figures. Because there's only one revenue account, we write the total of the revenues to the far right. The second column is used to add up all our expenses, so we list them all together. We've got several expenses here, 5 of them. But the total expenses will be written in the far right line. It just makes everything easier to read. Someone reading this statement could quickly just look at the far right column and say, okay, total revenues are $23,660, total expenses are $15,451, And the net income, if it's positive, or net loss, if it's negative, is written right underneath that on the far right column. Remember, we always underline before totaling something up. That's why we have an underline here and an underline right over here. And then our final figure, or the bottom line, where that which is another word for income or profit. The bottom line, you may have heard of that before, is double underlined. And don't forget the dollar sign. Okay, let's go over the term revenue and what it means. So what is revenue? Selling goods or services produces revenue. What impact does revenue have on equity? Revenue is an increase in equity resulting from the sale of goods or services in the usual course of business. So it increases equity. Or, if you want to think of it in another way, it makes the company richer. A company is paid $500 for services rendered. Here is our example question. A company is paid $500 for services rendered. So we performed a service and they paid us $500. Before using the revenue account, so the old way of recording this would have been, we would debit cash, because we received cash for $500, and we would credit capital for $500. Remember, this is the old way of recording before the expanded ledger. We put everything in capital. Using the revenue account, so our new method of recording would be a debit to cash, and instead of crediting capital, we are now crediting a specific account called revenue, or many times called fees earned. Note, the debit and credit does not change. We're still crediting to record the revenue, except we're not crediting capital, we're crediting revenue. So it's still a credit under the owner's equity section. Okay, how do revenue accounts behave? And what we mean by this is, how do they behave in terms of debits and credits? Okay, please don't be frightened by this. We've already seen this, so I'm just going to pull this up quickly. We know assets, liabilities, and owner's equity, how they behave in terms of when they increase or decrease, whether it's a debit or credit. Specifically, please look to the right here. We want to analyze how this affects now this new revenue account. So does revenue typically increase or decrease owner's equity? Well, we know that revenue increases owner's equity. Is the normal balance of a revenue a debit or a credit? Well, the normal balance for revenue is a credit. Therefore, revenue increases by crediting and decreases by debiting. Now, we'll almost never debit revenue. It does happen, but for now, the normal recording of revenue is going to always be credit. So revenue represents an increase in equity. An increase in equity requires a credit entry. Therefore, to record revenue, credit the revenue account. So that's the most important thing to take away from this, is to record revenue, we credit the revenue account, whatever that may be called. Many times it's called, say, fees earned. So we would credit that account. Okay, this brings us to another GAAP, or a generally accepted accounting principle, and this one is called the revenue recognition principle. So what is it? The revenue recognition principle states that revenue must be recorded in the accounts, in other words, recognized in the accounts, at the time the transaction is completed. So it really, what this principle wants to get through is that we do not record revenue when we receive money, but when we complete the service. So what does this mean? On account revenue is recorded when the bill is sent to the customer. So if a customer orders something from us and they're going to pay for it later, when we send that bill off, that's when we record the sale or the revenue. Cash transactions, we record those when the sale is completed and the cash is received. So really, to summarize this, when we complete the service, that's when we record the sale. Does not matter if we're getting the money right now or getting the money 30 days from now. The sale portion of that is, or the revenue is recorded right away. Okay, that's it for this part of the lesson. Click on the part B to go over expenses. Thank you.